a good starting point. At least, as we all know, we are on a journey on ESG. We focused a lot on energy efficiency, which is still good, reduce CO2 emission, now looking at the carbon, the embodied piece, but also the circularity is more and more interesting, measurable. The social taxonomy is coming up more and more. So it's getting even more complex in the future. So it's good, it's a status quo. And what I just want to do, give a quick overview of the report, not in detail. You can download it from the UNI INREF homepage, PwC homepage is all on. And then a bit of the results of the technical research, and then a bit of the market research, because it's based on best practice examples, and then we go to the panel and hopefully get some food for thoughts for the panel discussion afterwards. So the overview. Pick my notes. What have we done? At the end of the day, two parts. One is the technical part. As I said, it's a long journey. We picked the status quo of different frameworks, standards that are framing the ESG journey more or less, to give a bit of transparency what is currently around in as relevant pieces. And if you can see, or as you can see on the right-hand side, we are talking about frameworks and scorings. We are talking about reporting standards. We are talking about accounting standards. We are talking about certifications. And then on which level are we talking? Usually it all comes up from the asset level, where you see the certificates are pretty well established, but it has to come through the portfolio into the corporate level and then up to the stakeholders, that's where it is reported to. And then, of course, as I said, we also produced some case studies with some of the big investors, where I will just give a quick overview. And the markets we were focused on is the European Union, UK, US, Canada, Hong Kong, Singapore, Japan, and Australia. So the most relevant, I would say, institutional market at the end of the day. And coming now to the technical research part and the key results, we have more or less 10 key findings. One, of course, is no surprise. The reporting landscape is currently pretty complex. So there are so many different frameworks, as I've shown on the first page. And I think the challenge for the real estate industry, some of these frameworks are not produced for real estate. So it's, let's say, our job at the end of the day to be more focused on quality than on quantity of data, bringing a pragmatic way forward to be able to use these frameworks, because otherwise a regulator will say, look, the real estate guys are not delivering, so we have to sharpen perhaps the regulation especially on real estate and real assets. So that's a bit focused more on pragmatic ways and not doing always the German way to be over perfect. I can say it as a German, so be a bit more perfect. What we also learned, there is number two, it's not no one size fits all approach. So everyone who's looking at all this framework has to decide what is relevant for us. Yeah, which frameworks are really relevant for us from a regional, from an asset type perspective. We assume that over time, in the next years, we will see more and more consolidation and alignments of these different frameworks, because we see, as I said, this global perspective just doesn't make sense in the long run. So we will definitely see some consolidation and alignments, but the individual investor or stakeholder has to pick which are relevant for me and where do I want to be from an ambition level. The next point is the 5 categories, more or less, we identified. So we're looking at core corporate standards, thematic reporting standards, sustainability, regulation-related requirements, industry-specific requirements, and principle-based commitment. These are the 5 different, let's say, categories of regulations we have seen. I know it's a bit technical. Usually I'm presenting market reports or something. It's easier for me as a deals person. But this time, this research is, and you can read it, it's really, let's say, interest for the people who have to, let's say, act on ESG strategies. A big topic is the double materiality, which is more and more relevant for us to see what is the impact of my investments on society and environment. That's the one direction, and the other direction, what's the impact of the environment and the society on my assets. So in both directions, it's a double materiality you have to keep in mind. And of course, a big topic, and that's what we have seen in the case studies, is it's all about data. The good is you can't manage what you can't measure. So that's still a big point. We had a discussion with one of the large broker houses yesterday, and especially in Germany, and we can discuss other markets. Germany is still it's a mess on data. Yeah, but you need this data, and of course there is a big universe of startups focusing or data providers where we can at least benchmark and get at least an understanding, but at the end of the day of the journey, we need the real data. So it's a journey. It's also about investments, but it all makes sense. And I'm really looking forward to the discussion later in the panel. I'm not looking only at from a cost perspective, but also from a value perspective. We are delivering with investments into the buildings. The sixth point is it's over here. So building certifications is more or less when we talk globally, especially in Europe, to clients, they say, you have a building certification. It's a good starting point, that's right. But with this universe and complex regulatory frameworks, also the certifications are more and more under fire to really deliver the content. As I said, certification is a good starting point, but they also have to change. And it's not enough only to have a certificate currently in the market environment. Social standards, I already mentioned, is something that's more and more coming up. It's more difficult to measure. It's more measured on values and norms. But definitely the EU taxonomy, the social taxonomy is also coming up at the end of the tunnel. Good governance is fundamental. Definitely, that's something where the European Union is really, really great currently, and all the world is looking at us and try to learn what have you learned over the last years with the Green Deal. Because we are most advanced globally currently. And then it's, of course, best practice sharing. And in these complex moments, we have to learn from each other and see what the best practice could be, because you can't be perfect and you can't fulfill all the requirements. But what's the best pragmatic way forward? And number 10 is, of course, the successful sustainability strategy. As I said at the beginning, you have to pick your ambition level, where do you want to be, and who are your stakeholders, and what do your stakeholders really want from you. And then you can decide which regulatory frameworks are perfect for you and which are relevant for you to define your strategy. And we had the discussion before, it's not the strategy you can do, or we always have the client discussions, please give me the checklist for my ESG due diligence. And we say, no, there is no checklist. Yeah, you have to define what you want, where's your ambition level, what's relevant for you, and then you can define what you have to do. So that's more or less the 10 findings. As I said, you can download the whole report from the different home pages. And just a quick, just a minute on the best practice, because that's something we want to discuss today, best practice sharing. And as I said, it's all about data, and we picked. On the right-hand side, you can see that we try to pick best practices from the big global players, as AXA, as Heinz, Manulife, Azora, CBRE, investment management from the asset level. How do the data flow up through the portfolio, through the management corporate level, up to the stakeholder demands? So that's more or less the journey we are describing here with the best practice sharing or the best practice topics we have shown. I don't want to go into detail. You can read it, and we will discuss best practices later on the journey. So that's the overview of the results of the study. Hand over to you.
That was a really good introduction, actually, to my presentation. Thank you. So I'm going to dive more into the actual assets, and that's my favorite subject. Firstly, I'm going to say a big thank you to Thomas for hosting. It's a lovely venue, and thank you for coming from all parts of the world. So yes, ESG and the risk of stranded assets. What is stranded assets? These are assets, buildings that have suffered either from physical or from transitional risks. So floods or the energy transition. It's as simple as that. And in just bringing the German government and what the requirements are, the German climate targets require an almost complete reversal of Germany's primary energy consumption, 80% of which at the moment is based on fossil fuel. So climate neutrality by 2045 means that the use of diesel, coal, or natural gas in Germany must be ended by that point. And therefore, the buildings need to follow this transition. Otherwise, they'll become stranded. 1.5 trillion euros. This is how much it will cost to really invest in decarbonizing our buildings in Europe over the next 30 years. So that is a huge, huge number. And 80% of our buildings today, they're going to be here in 2050. So we've got a big challenge to sort out, and it's going to take time. And that's why we're here talking about it. In terms, just to give you an example, warehouses, only 5% of the warehouses in Europe have got PVs on the roofs. So still a long way to go. And that is the CREM tool that Thomas was talking about under his asset tools, which is the carbon risk real estate monitor tool. And that's what we use to understand how buildings perform. And it is based on real data. So we need the actual energy consumption of the buildings to be able to analyze them and understand if they're stranded or not. The green line is our decarbonisation pathway. This is a UK example. So I've got a really bad UK example and a really good German example, just to cheer you all up. So this is the UK energy reduction pathway and our decarbonisation pathway there. This is what we need to follow. So basically our buildings, when we plot their energy consumption over the years, they should be below the green line, ideally. And this is the building I'm going to talk about. This is a 1990s building in the UK, which we went and physically surveyed, and we also collected all the data in terms of energy. So basically, what you see in blue is the excess of carbon generated by the asset. So this is a pretty bad asset, basically, because it has gas heating, which doesn't help. We've done quite a lot of modelling trying to bring in retrofitting ideas and solutions to upgrade the building and see how we can improve the stranded year. So in this case, it shows that it's stranded now. And after introducing PVs, we've upgraded the actual fabric, so we've improved the U values. We've used air source heat pumps, and we managed to give the asset 20 years life in terms of the stranded year. So you can see that it's moved to 2041. Not quite down the 2050 yet, but still very good, and there will be a lot of financial benefits on doing that because of the energy reduction. So for people in the UK that talk about EPCs still, and EPCs is a very theoretical way to assess buildings because it doesn't really use the real data as the CREM tool does. We've done an analysis with the EPCs, and we've also shown how the different retrofitting measures will reduce the carbon emissions. And you can see, if we implement all the measures, we can reduce the carbon by about 90%. LEDs were also there. They are making a huge difference. Just changing LED lights and introducing PVs and air source heat pumps can make a huge difference to building before we start changing the fabric. What is it going to cost? I thought you were going to ask that or think about that question. That is the amount. And you can see that half of it is the fabric improvements. And this is why we're saying when we design new buildings now, we want to make sure that the fabric has got the right U values, so we don't need to go back and retrofit because it can cost a lot of money. We'd rather spend it now, which is a lot less, and have a building which is future-proofed when it comes to the net zero journey. And now the good example. So this is a new building in Germany, and not only doesn't get stranded, it generates energy. You get more energy from the PVs than you need. So you can see on the red and blue, the red is what is required, and the blue is what we produced from the PVs. So for this example, there was about 35 kilowatt hours per square meter per year that we can generate through the PVs. Quite impressive. And that's my last slide. This is really a very interesting global survey that CBRE did, 2023, and it revealed the importance of certain environmental building features on property values and transaction decisions. And I think it's quite revealing because the way they set it, you can see that it can affect the actual value if the energy efficiency is there, or they might ask a discount if it's absent, or they might even reject the building. And then they've created a nice matrix at the end that prioritizes what is more important, and reduction of energy consumption is number one priority. We need to be doing it. We do need to be looking at both, obviously, new buildings, and by 2030, we need to make sure that all the buildings that we are building are net zero. All buildings that are designed by 2025, they need to be designed as net zero. And of course, we've got to start the decarbonisation of existing assets because there's quite a lot of work that needs to be done. And that was me. Thank you.
Great. So just a quick minute on yourselves and what you do, just so that everybody knows who everybody is and the different perspectives. Let's start with you, Jens.
Yeah, hi. It's good. Can everybody hear me? Great, good. Jens Thaler is my name. I work for P3 Logistic Parks, and as the name gives away, we build warehouses. Our company owns a lot of warehouses across Europe. We're top 5 owner and developer, so investor and developer. And yeah, in the German business, I am responsible for the technical part, so meaning the construction, the planning, and the TDD phase during investment and development.
Hi there. Hi there. My name is Christian. I'm managing partner at New World Investment Managers. We are investing in managed residential assets, so ranging from PBSA over service apartments, senior housing. We also do kindergartens, co-living, everything around that, with a specific view also on ESG topics for sure, but especially on, since we manage money for our investors, on improving the value and in the end earning money, providing returns.
Okay, great. What I'm going to do very briefly, you take that microphone back again, and then I'm going to swap you two around without anybody here noticing, so that then you can share that microphone and you can...
Okay, so I'm one of the co-founding directors of B Design and heading up the ESG and sustainability team. My passion is ESG. What we do is really can be put into 3 elements. The first one is designing new net zero buildings, and that's a holistic approach. We've got engineers, architects, sustainability consultants that they can do the whole project. The second one is the decarbonisation of existing assets, which is what we talked about earlier, and we are working at the moment on hundreds of buildings, warehouses, offices, care homes in the UK and Europe, helping our clients in the net zero pathway and their journeys. A lot of them have already declared that they want to be net zero by 2040 or 2045, so there's a lot of work to do there. And the third one is to help companies define their ESG strategies at corporate level. So this is really aligning the projects with how they do work, how they operate, their culture, their mission, values, vision. So it's really helping them to define all this and make sure that they have a clear plan on the ESG strategy.
Great, Steve.
Hi, good afternoon everyone. My name is Stephen Oakden. I'm a chartered structural engineer. I've been designing logistics buildings for over 30 years, which I know is difficult to say. But 10 years ago, Anna, I and our colleague Simon set up B Design with a slightly different approach to delivering our services. A lot of my work over the past 8 years has been based in Europe, and recently with Nina now I'm the managing director of our German business as well. My specialism is helping developers unlock really challenging sites. So if you've got sites that are old power stations, sewage treatment plants, coal mines, I've got heavy contamination on it, we have a skill set where we find a way to make those sites come back into use and become, again, good assets and developable assets.
Great. Thomas.
Yeah, I also skipped my introduction. So Thomas, I'm a partner located here in Frankfurt at PwC. I'm leading the real assets industry, so a combination of real estate and infrastructure in Germany, and took over the global lead for our real estate teams last summer, so coordinating the real estate activities around the globe. And of course, one focus topic is ESG, the other is digitization, and it's strongly linked. And we feel that this is a really fast-growing topic. Everyone is talking, or at the beginning, everyone was talking and discussing and drinking coffees and having panels. And now it comes a bit too in action. I feel not enough, but that's something hopefully we will discuss. And that we will have to move faster and we still have it in our hand, and we don't get kicked and pushed as the aircraft industry yet, but we have to be careful not to be in the middle of the political discussion.
Great, and certainly we've been seeing across the sessions that we've been running, not just ones focused on ESG, but actually ones focused, whether that's on financing or logistics or residential or all of those sectors, that ESG is playing a huge part in that. But also, again, that move that you mentioned there, which is from everybody thinking that it's a good idea to actually now getting down into what does that mean for everybody. And I think the stranded assets bit that you mentioned there, is a big driver in that. It might be good, since you've got the microphone, Christian, let's just start with you. Obviously, you're coming from the residential sector, but I suppose how are you looking at particularly ESG at the moment, and especially looking at that? I mean, Anna mentioned there about development sites, brownfield sites, new sites versus redevelopment. What's your kind of overall take on that?
I think if you're planning on investing institutional money right now, you don't have any chance to do so if you're not considering ESG from the very beginning. Mm. And I'm not talking about the pure requirements out of the SDFR, correct, right? Yeah, where you just have to disclose what you're looking at, but most investors are really seeing some more meaningful, purposeful approach. And if you are not able to deliver that as an asset manager, also as a developer for a new asset, it's really hard to get the necessary funds to execute on a project. And what Anna said in her presentation was quite interesting, and I would actually directly ask her, aren't there even more stranded assets already? Because in terms of the business plans that lots of investors have in place, which based on the time they acquired an asset, 5 years, 10 years ago, didn't account for any kind of ESG measures. And now you have to, at some point, potentially sell the asset because your business plan matures, and then you realize, well, there aren't investors out there buying assets that are not really on a good ESG, CREM, whatever path, where you at least see some light at the end of the tunnel. And I would say, from my experience, also with residential assets, there are so many buildings out there where, in terms of pure numbers, it's more or less hopeless. You can't do anything without going to the investors and say, look, what you have right now, if you want to really turn it on a net zero pathway, it's more or less worthless right now because you have to invest so much money and so much energy in terms of work and ideas to create something that is sustainable for the future.
This is so. Oh, sorry. Yeah, is that a question for me? Yes, it is. It's absolutely right what you just said. There's still a lot of people that are designing and specifying buildings that are not quite net zero, because the short-term financial returns are more important to them than the long-term picture. So there's a huge challenge there, how to balance the two. The one thing that I believe will change the whole picture is the fact that in the next year or so, there will be a lot of regulation to define what we're doing, which will help, but also there will be a big emphasis on the embodied carbon, and new buildings come with the premium of having to deal with embodied carbon, and that will really change this. It will shift the focus, and the existing buildings will become so valuable and so important to to improve and work with them. It will be more financially, it will stack up more to deal with an existing building than to build a new one. But not yet. I think we're about a year away from that, but you're absolutely right.
It'd be interesting to pick up from you, Jens. Obviously, you're a long-term investor rather than a kind of short-term fund. So obviously, you're having to look at that, especially if you hold a number of the properties. So I guess, how are you seeing that? And are you seeing it as an investment that you need to take? And what's the position between new development and obviously existing assets?
As you just said, since we keep every building we build in it, essentially, except for rare cases, we have to have a strategy in place for the next at least 50 years for buildings we build right now. And what happens in 50 years, nobody actually knows. Nobody has that crystal ball, right? And that means we must do our best today to define what our tenants need in 50 years, and they are essentially our driving factor here. Because if right now we've got a good lease situation, we've got about 100% of every square meter in Germany is leased out, and that's a lot. And this might change in the future. The stranded asset is a term that's very relevant to us because we are kind of careful to not create that situation. So that's what this all is about for us, to make sure that in the mid and long-term future, none of our buildings will be stranded in a way that we don't find tenants who actually want to live in them. That's a relevant one. So we, of course, separate between old buildings, so the ones that have already been created. We have buildings in our portfolio that have been created in the year 2000. At that point, half the population didn't believe in global warming. So those things are not really relevant for ESG at this point, so we got to find ways. Of course, low-hanging fruits are, for example, LED retrofitting. That is quick work, and by comparison, of course, it costs money, but return on investment is relatively easy to be seen by comparison. So we are working on those buildings. In general, since we're still in the fact-finding mission, so what's the best measure to get onwards with ESG, which combination of measures? Since we're still in the fact-finding mission, but we need to do something right now, we decided as a company to go for BREEAM as a certification for all of our buildings. So essentially, every new building right these days in all across Europe has BREEAM Excellent as a certification. That's the foundation which we build on, and from there, we take it slowly in different directions. So we've got several approaches that go over and beyond BREEAM, because that's only the foundation. We need to take it further. This highly depends, really. There's easy ones where everybody knows that's required. For example, insulation of buildings. In the year 2000, nobody knew where it was heading, as I said. And we don't know what in 20 years. One thing we know for sure, there's going to be more heat waves, so insulation will help against that. And if we heat in the winter the buildings less, that's good as well for our carbon footprint. So insulation is an easy one. We can say today more is better, essentially. Other ones are more complex, for example, the heating of the building itself. And that's where we're still, as I said, in the mission to find the real deal, the answer that will hold still in 20 years' time. Mm-hmm. But that's the same for all of the market. I've been visiting quite several sites in the last couple of months, which we potentially would buy, so existing buildings built in the last couple of years, and there's every means of heating in those buildings, every means. Some are rather exotic, other ones are basic. It's everything there because nobody knows for now, and that's a good one. In a couple of years, hopefully in time, we will have that answer, which is the best solution here.
Good. I noticed climate resilience actually was one of the top things that people were looking for, or one of the reasons they might not buy as well in that chart that you had at the end there. And it might be interesting, Stephen, just to pick up from you, how important an element is that? We mentioned there, Jens there mentioning that there's a growing focus on that from their side in terms of, because we haven't managed to deal with global warming in the way that we thought we should. How much of an issue is that, do you think, for institutional investors, and how much can be done about it?
So I think there's two things here. The idea of a fabric first policy in terms of new development is definitely the way forward. If we're building buildings that require less energy to run, to keep warm in the winter, keep cool in the summer, that obviously has to be the most appropriate way. And the discussion about whether we're going to maintain our 1.5 degrees target, I see the media are already starting to push that aside and saying it's a lost cause, which I don't think it is, but there is an awful lot of work to be done to get to that position. Where I'm seeing things now in the UK market, we're starting to see people actually moving out of old assets to new assets because they're bringing corporate policy that's saying we've got to be in a grade A building, with a good EPC rating. And so what then happens to those old sites? And if anyone asks you what is the most sustainable building solution, it is not to build. And therefore, the sustainable thing to do with those old assets is to try and find a new way of using them. And sometimes an old logistics building probably won't be suitable for a new logistics market. But we do need to start looking at that, I think, and that is probably something that we'll start seeing more of over the next few years. And it may be that funds start to actually relaxing their rigid rules around what they believe is a fundable asset.
And it'd be interesting just to pick up from anybody here, just in terms of is the regulation pushing us in the right direction, or sometimes pushing us slightly in the wrong direction, or not entirely supporting, particularly areas like, we've had a lot of discussions around repurposing, and of course, one of the natural things to repurpose office, for example, is to residential, but a lot of mayors and cities don't want that because it means there's a higher usage of schools and everything, and actually they don't get the income from the office anymore. So it'd be interesting just to get, I guess particularly Christian and Jens, from your position, because you are developing and looking at redevelopment versus development, what your kind of take is on, I guess, what you're looking at the moment, particularly in the German market as well. I'd be interested to hear.
I'm just thinking, I think the regulation, as Anna just said, we're not quite there yet where the entire market really knows what the impact is going to be. So right now you have to disclose, if you're an investment fund, you have to disclose what you're doing, what you're looking at, and if you are very adventurous, you can try to add some real purpose to your structure, and then you start most likely getting in trouble with BaFin quite fast, because they most likely see it differently, and then you start arguing about little details before you really start investing. Having said this, I assume that in the next years we're going to have a much clearer picture of how the investment landscape also is going to look like with new build assets and redesign refurbished assets. What you just said in terms of mayors of smaller cities don't want conversion from office to residential, for example. I think that's a complete different discussion where also on the federal level in politics, the people in charge on the topic of energy efficiency, whereas the people in charge of local tax income, I dare to say they don't really talk to each other, and they only have their own agenda and trying to come up with what is best for their little department. I think we can be quite happy in Germany that we have something like the TIA, for example, trying to bring lots of expertise into the politics and help the lawmakers to see the big picture. However, right now, I think when you see an asset or a project that fits your requirements in terms of your personal company story, and you have investors for it, in today's markets, go for it. I think it's, if we look out there, almost no transaction happening right now. I think all people from brokerage firms and advisors would agree that there hasn't been a new market, where you say equilibrium found, where people know what the real prices are for assets, because most assets don't trade right now in terms of price finding, because we just have this interest rate shock.
It'd be interesting to pick up as well, Jens, but just with you as well, just because you're obviously balancing risk reward in terms of the development, because everything, the numbers still have to stack up, I guess, when you're developing. You're looking at what the, resilience, obviously, but other things that you would like to be doing, but there's not an incentive to do, for example. How do you see that?
The risk-reward question is actually a quite challenging one, of course. We see in a lot of buildings, we aim to procure at the moment that there's high ESG standards set up there, and it is unsure if everything in there really gives the reward, monetary reward, that's been looked for. I guess the main driving factor is not have stranded assets from the get-go. So a lot of developers are only building to afterwards simply sell the building with most likely a tenant already on board. And that's the challenge, yeah, for most companies. There's this huge fear of having stranded assets from the start, because everybody right these days looks for ESG. And only 5 years ago, certifications in warehouses were rare. DGMB, the German standard, was kind of often, but these days there's rarely a building that has no certification. But that's the baseline. Essentially, question would be if we are being driven by the market, so the potential buyers of the buildings, the tenants, or by the regulatory side, the code. Right now it's a mix of both, I guess. I guess we need to be driven to more ESG compliant standards. On the other side, there's a big self-interest in the market as well.
Okay, good. Thomas, it'd be interesting to just get from you, are you at a stage where you see this as an opportunity, in a way that the transformation that needs to come, that Anna was talking about, 1.5 trillion, that this is also potentially a big opportunity for everybody in the room?
I'm a needs person, so I'm always positive, and I've seen that crisis came pretty fast and ended pretty fast in the last. I've been through 3 cycles now. Especially this one, we had a discussion 3 months ago if ESG is now for a drop off the agenda, as we have seen in the last cycles. And I hear something like this from my US colleagues, but in Europe, as the European regulator is really pushing hard, and he's not moving away. And that perhaps one comment to the question before, I think the regulator on the European level is going really straight in the right direction. So starting with energy efficiency, with resilience, now with the social taxonomy, with circularity, with biodiversity, all these are the right topics. Yeah? Because if we want to change, I think the challenge comes on local and regional level. If we talk about tax rules on solar panels in Germany, it's a disaster. Something has to change. Or if we do local laws and change the type of use, building right, that's still the problem. But of course, yes, I see it really as a big opportunity. I think in the panel I was last year, when the question came up, what do you see the best opportunity? I always said it's the value-add strategy transformation into green. So building, buying brown assets, transforming into green. I think that's still a good strategy. Yes, we are struggling currently on the price point, even without this topic. But we are getting closer. I think the second one was investing into venture capital or startups focusing on ESG transformation. That are still the true opportunities I clearly see in the market. And this morning I had a discussion with our German partners also about market sentiment. And he said, look, we are currently selling a resi assets in Berlin. Last year, we would have, so 2 years ago, we would have seen it as a multiple of 33. Now we have a willing seller at 23, so down 10 multiples, and we are getting closer, but we are not there yet. So and if you add up, and that's something I discussed yesterday with the sustainability team and the CEO of one broker houses, we are comparing our asset tools, like say how we measure ESG, and the investments we have to put into the transformation. And there are, let's say, tools where you can calculate on the Crampass. We had a discussion, do we use 1.5 degree or 2 degrees? Interesting discussion, but I think we should all head still for 1.5 degrees, even knowing that this is already unrealistic, but most corporates still do that. And then playing around, what's the best investment, also from a Crampass, what makes sense from a risk-return profile. And in the past panels I've been in, ESG was always a cost discussion. I say, we have to reduce the return in our funds. We can't spend this money because we don't have it. We are not allowed to, blah, blah, blah. And we have to switch into a value creation discussion, because investing 5 million, I think there was one calculation there. And yesterday in the tool the colleagues presented, there was, investing 5 million and the value came up 4 million. I said, let's squeeze a bit more the other way around, invest 4 million and the value goes up 5 million. I think that's really the reality, because we already see that at least the big corporate clients, not the residential individual, I would say, but the big corporates have their own ESG agenda in existing building as well. And new building, we have to deliver standards. It's not the standard. Every corporate has its own strategy, its own requests, depending on the stakeholders. But it's more and more driving the market. And clearly the transformation, as 80 to 90% of the stock, is really the issue, not the newly constructed. It's also a challenge, but the transformation, the renovation, the retrofit, that's the big challenge, but also the big opportunity. If you see really cost efficient, if you have a good technical team knowing what you can do, and looking what is really a meaningful investment into the existing asset. And it's not that. I was struggling a bit when I heard that I'm naive, I'm not a technical person, naive, just if I would set up a new logistics building right now, I would buy not green land, I would try to buy brown land. It's naive, you have to get it, of course. Creating the building with low zero building materials, putting on a green roof, putting on solar, putting some green stuff on the facades, putting heat pumps in. I think that's an asset which is reasonable from a construction cost side, might be higher than the straightforward way, but that's a sustainable building, and some people are, I'm happy to have the questions later on that, but to be really naive, that would be assets, and transforming residential assets it's not that difficult. We are always a bit hiding. We don't know what's coming up the next year. I think the big topics are really on the agenda. Reduced zero, you have to know which materials are in the building, what is the impact, the embodied carbon in the building. It's not just about the new building, it's also looking at all the tools. They are not involving, they are showing the path on the energy consumption, but not the embodied carbon of the retrofit. That's always that's something we are still missing, and we have to do it. Otherwise, it's not the right calculation we are doing. It was a long answer to, I don't know, did I answer the question?
No, well, that's one of the interesting things, that these are quite complex issues that everybody's having to suddenly deal with. And again, regulations coming, I mean, you mentioned there BaFin, and we've also got different regulations coming from different areas. And as well, you're absolutely right to point out that as well as the EU having taxonomy, that countries, cities, and individual companies and investors and pension funds all have their own set benchmarks that they want to achieve. Interested though in that point about the brownfield sites. Just Stephen, from obviously you're looking at that. I mean, what does one often meet with that? I mean, is it around clearing the site from potential issues that there were there? What are some of the challenges that you get? And then I'll come to you, Jens, to see whether or not Thomas was naive or whether all of that is very practical.
I mean, the challenges we see on sites range significantly, but if we've got an old steel mill, then below ground obstructions are such a problem. Of coal mining sites, if it's open cast, issues with settlement of the backfill within the coal mine. So these challenges are always there, but it then comes back to sort of a circular economy approach here, I think. So if you've got a site that currently has an existing building on it, within the circular economy approach to life is what can I utilise within that site within my new development. And you might not say, okay, I can't actually utilise the building as such, but I can utilise the materials by crushing the concrete and reusing that as part of the fill material. If the site is of a reasonable condition, you might be able to rescue some of the softer finishes within the material and reuse them. But it is trying to find ways of optimizing that reuse so that it becomes an asset that can then be developed, because if the abnormal costs on a site are so high that it pushes the asset or pushes development price out, it doesn't matter what your interest rates are, you'll still never develop it. So that's really where we're looking at. And the strange thing, there's a couple of strange things I find with sustainability at the moment, and I'm sure these things will work their way through. Is that when you're looking at circular economy, a lot of this is measured around things like tonnage. So it's, here's a site, how many tons of that site can I reuse? So if I can say, I can break up all the concrete and I can crush it, you suddenly say, well, I'm actually reusing 90% or 95% of the tonnage of this existing site. And you suddenly start scoring very, very good points. Okay, you're probably not reusing some of the higher carbon products like the glass, but it's an interesting way of measuring at the moment, and I think that needs to be looked at more carefully going forward.
Okay, good. I'll come to you in a second, yes, but Anna, from your perspective, is that sort of, I mean, we're seeing it certainly a lot more, the discussion around cradle to cradle, but also reusing huge amounts of buildings. Is that something that is practical? Is that for all solutions, or how do you see that?
It's hard, it's challenging, and at the moment is not a clear requirement. We do need to create comply with the circular economy statements and there are ideal percentages of material that we need to be reusing. But just bearing in mind that by 2030 we need to be building net zero buildings, that means that 100% of the material that comes into the building is recycled material, and also 100% of the material that is within the building after it's been built needs to be recyclable. So from 2030 it's not going to be a question of so we do it or so we do a little bit of it. It's like we have to comply, and it will become harder because the more we leave it and the more we make it into an optional, we will end up having to catch up quite a lot. There is a lot of technological advances we need to have in place. Just a bit on the regulation, I agree with what you said, Thomas, in terms of the European picture. There's definitely a lot of regulation here. The EU taxonomy and a lot of frameworks, they are really developed in Europe. I would say in the UK we're a bit behind, and we haven't got standards to really deliver the regulation. And a good example is the famous net zero standard. It doesn't exist. There are 20 different ways to deliver a net zero building, and everyone will do their own way. Luckily in the UK we are involved with LETI, UK, GBC, BRE, and we're part of the 3 consultants who are putting together the net zero carbon standard for warehouses. So that will cover both the energy and the embodied carbon, and it should become available in the next year or so. But that is a lot of work that is happening in the background. It's not being supported by the government. This is all voluntary work, which we hope that it will then be really taken forward by the government and will be supported. One final comment on Thomas again. I don't know why I'm referring to you again, but you made a point about the value of the building and try to balance it and make sure that what we spend to upgrade the building is really becoming a financial kind of viability scenario. I would like to throw another word into the conversation, and that is reputation. I think reputation, it's hard to give a value, but certainly developers and investors who are more ESG focused and sustainability focused, their reputation in the next few years will really pay a lot of dividends.
Okay, good. Yes, pick up any of those points if you like, but also, I know there was a lot in there, but pick up any of those if you like, but also that point around brownfield sites, because obviously I'm assuming that, like for the majority of logistics ones, there's much less of a focus simply because of availability of greenfield sites, and so you're having to look more and more at these kind of brownfield locations.
Straight answer, if we want to do business, we don't have an option but to go for brownfields, of course. Because there's a big difference. There's a lot of companies out there that have been created in the 50s, 60s, and the whole business case doesn't work these days anymore. So those companies stop their work at some point, so there's open ground, which we can reuse. It's a different topic here in residential. We never stop living somewhere, but businesses stop working. So we've got a lot of brownfields out there. In the last couple of years, they grew scarce by comparison as well, because we took everything that was available. The whole market was kind of empty. In general, for the moral standpoint, we love to do the brownfields as well. By comparison to taking green land, converting a brownfield is way more interesting. However, on the other side, this is about the most challenging thing that we can do. It's really complicated. But still, it feels good. It is good. We can use this afterwards, of course, and nothing feels worse than having big empty fields that nobody uses, and right next door there's agricultural lands that are being sealed off. For the topic of value add of ESG, to pick up on any of those points, it is very complicated for us these days to put a price tag to ESG. Because we are living in a free market, and the market in the end will create the price for it, right? Buildings we are buying right now, they feel a little higher in pricing because there's a lot of sustainable measures implemented that wouldn't have been implemented a couple of years ago. But then again, if the building will not be bought for that price, it is complicated to put a price tag to it. Let's call it that. The way forward for us here is, and there's a big difference to residential again, The clients, the tenant, our lease holders, so the parties we lease our buildings to, are big corporates mostly, and they grow more big every year. So that's the way the world works, right? So smaller companies grow less by comparison to big companies, and big corporates, all of them have their own ESG agenda, very strict ones usually, and they grow more strict each year. Each company has their own vision for ESG, and that's the main point where the price tag will come from in the end. If the building can be leased to a company, or if we reduce the range of companies that can lease the building because it is not ESG compliant to their own agenda.
Okay, good. And Christian, just in your side, I mean, differences with the living and residential sector, but you're still developing, you know, largely with institutional investors in mind, for example. So I guess what do you have to think about when you're planning those kind of buildings for the institutional sector?
I think it's all about reusability and stable cash flows that are predictable also in the far future. So when we are looking at student housing, for example, we always try to see many years in the future when, for example, a local university is relocated or even shuts down, and single apartments aren't the flavor of the month anymore. So we think, can we then combine two apartments, make a larger unit, maybe transform it into senior housing someday? So it's really about a long life cycle approach, because what we've seen in the past is that lots of projects that started with a simple single idea in mind had to undergo multiple changes, each one of them connected with additional capex for the investors. And if you can provide a long-term investment story saying, okay, we are, whatever the future brings, able to accommodate to these changes and are able to not only from ESG and energy perspectives, but also from the change in the habits of the users, for example. It's the same with logistics. I think at one point you know how flexible you can build a new building so that you are really able to adapt fast without long periods of no cash flow when the building just sits idle.
Okay, good. I wanted to, if anybody's got questions, whether that's around questions that they want to ask, whether that's around the strategy side or the technical side or any of those, please do. Just raise your hands or shout out or stand up or whatever is required. Or if you've got a perspective that you want to bring to the discussion, please do. The floor is open for that, so if anybody does, let me know. You've got one, okay.
Yes. For Thomas, actually, you were saying on your slides, it's all about data. But what is the relevant data? I mean, we can all collect many bits and pieces and then say, okay, we have this vast database of anything, starting from how long people are staying in one room. I mean, it's your daily business in a way to work with these things. But so what is really relevant right now, and what's going to be relevant in the future?
Yeah, I think I'm not too detailed. I think we have some technical experts around that could be more detailed on that. But in general, it's what do we want to measure? It's about currently or the past 2 years we focus on energy consumption. So it's easy to say, yeah, we just have to measure the energy consumption, heat and electricity in the building. Yeah, it sounds simple, but knowing the German the German rules, the German rules in leasing contracts, in old contracts, you are not allowed to get the data. If the tenant doesn't want to give you any data on behavior, on consumption, it's not easy. Now we are, of course, moving more into the green lease direction, so there might be, but from an overall market perspective, I have no clue, but I assume not more than 5 to 10% of the lease contracts in Germany, at least, will be the same in Europe, I assume, will be green leases. So it's a starting point. So that's the, let's say, the core data. If you then look more on optimization strategies about this fantastic buzzword digital twin, of course you have to understand your building, what's in there, what's the general outfit of the building, and then it comes moves further down. It comes into circularity. You need to understand in the new building it's easier, but in the existing stock, what is really in this building? We all don't know. There are some startups, like I think in Germany, Madasta is doing a lot, but there are others, not just one, on focusing what is really in, also to measure the embodied carbon, because going forward in reporting, my view is in a couple of years we have a financial reporting, and separate of that you have a CO2 reporting fully on all the stock. It's not there yet, but it's coming. Then you would need what did I build? What are the stock made of? Yeah? And how can I create, as you can from a circularity perspective, how can I reuse these things? That's the topic. And then the next topic is coming on biodiversity. What's the impact of the specific building on biodiversity? So how much green space is there? What can be, how many, I don't know, animals can live on the roof, whatever the topic is. So that's more or less coming from the journey. And I think the EU, the Green Deal is a good, let's say, framework to look if you have the 6 environmental measures. That's a good starting point. If you try to measure, what do I want to measure, and try to get the data points. And the problem, of course, in all the global stock is you don't have smart meters in there yet. Yeah? In the newer building, yes, but in the other building, and then it comes to the local, and it gets tricky again on local law. You are not allowed to build smart metering into lease space. Yeah? And in existing lease agreements, it's difficult, but there's also a mindset change from at least the bigger tenants that say, look, if I want to have an impact and I want to contribute this data into the measurement because it fits good to my own ESG strategy. But it's a journey. It's a long, we are just at the starting point, it's a beginning, but these are the data fields, I would say, which we need. And there are so many fancy startups out there, and we created 2 years ago together with Billboard the first Tech for Impact map, where we scouted 750 startups globally that are focusing on ESG in real estate. Now we'll bring up the third map this year. So it's an interesting journey. Of course, the startups have challenging times currently, but if you look at the big ones that are really growing phase, they're really picking up really significantly from the valuation, even in this challenging venture capital times. Now, the real business things are coming because the clients, the end user, the owner really need this data.
Mm-hmm. And are there particular things that would be interesting to get anybody else's views on those as well, in terms of innovation, in terms of new solutions that are coming through that people should be looking at and integrating into, whether that's development, redevelopment, or managing the operation, I suppose. Are there particular things that you've come across that you think people should be thinking about? As long as you don't own them or have shares.
So, I mean, we've all talked about modular construction and new methods of construction in the UK, and I think modular construction in its way is one of these things that will help deliver higher quality products, certainly into the residential market and into the office market maybe. And with that and the generation of 3D printing, we were doing a little bit of research with a company in the UK which were looking to develop a process for 3D printing office modules based on a Kevlar structure. And so this is where you're starting to see real advancements in technology that are very, very different to what we're building at the moment. And these are years away, but I think these products will start coming through, and we'll start seeing trials of these type of products in the near future.
And it'd be interesting also to pick up that for wood and those kinds of things, which we're seeing a lot more of a focus on that.
Sorry, I've got a more general question. So we've got a situation where a lot of stock, be it housing stock or warehouse stock, sits within smaller independent landlords who actually could have quite substantial portfolios. And it's one thing when you're a P3 or a Panettone or a Prologis, it's another thing where you're a smaller landlord. So what I'm interested in what the panel's view of this ticking time bomb that must be there. The people that are out there holding property but just don't have the resources to invest in it. It could be a complete transformation of the market you see coming along, which is not really talked about. Do you have any sense of what that ticking time bomb is out there?
I think if the starting point often is a regulation, right? And this regulation comes down, is focused on financial markets. So we are then in the, let's say, more in the institutional world. So products, Article 8, Article 9, Article 8 plus funds that are focusing on that. They own institutional market in Germany is perhaps 20% of not residential, but the commercial part. So this is heavily impacted. The transformation will be faster. I think let's say the private individual, it's a tricky piece. I'm completely right, because there is no pressure. There must be an intrinsic motivation to do that. Where we see a significant heavier focus in is family offices. They really think over generations. They already focused on ESG very, very early, and they are heavily interested to invest into their existing stock. So the family offices are really focused. I don't have any statistics on individuals, but it's true. A lot of this resi housing stock is owned by smaller individuals. The pressure may only come via the competition with other stockholders, like bigger housing companies. They're offering, let's say, more energy efficient buildings. And at the end, after the significant energy price increases, there's also a price point to that. Yeah, it's about affordability. Yeah? If you do not invest into your building, the tenants will not be able to afford it anymore. Yeah? That's I think a market mechanism. I'm an economist, so I always love to have non-regulated markets. But in this, where the market can't manage the problem, regulation is needed and needs to push hard in this case. But overall, in the long run, I hope that the market will solve most of the problems. Yeah, and that's with the smaller tenant, it might come via the users that you are not able to, as a private individual owning, 10 resi units, that the tenants are not interested anymore in your stock. It's a long journey because the pressure on resi market, especially in the urban areas, is still there and will remain. Yeah, so that's there might be a regulation that go deeper into that, like we have seen in the Netherlands, where owners are not allowed to lease out specific spaces if they are above a specific energy level. And that's something that's also kicking in more and more on the EU, and that hits not only the big corporates but also the small individuals. But it takes longer than it should be. Yeah.
And Jens, do you think that's an element where somebody like P3 who's got scale, taking Paul's point there, who's got scale, is it an advantage to some of the smaller players?
Maybe it's a disadvantage actually, because the scale has the disadvantage of being multinational, and there's different rules in every single country. Was just mentioned quite fairly that, for example, solar market and solar regulation in Germany is challenging, and it's different in every single country. We're struggling with getting a true ESG strategy for a couple of years already, because to get one overall strategy for each and every country is it's really complicated in terms of, well, there are so many variables in each and every market, and that equation that you have to solve in the end is close to impossible. We're getting closer now, but we just agreed in the end to start with getting our foot in the door in every single market and get more data before we do a global strategy, because it was so complicated. So it is not only good to be big in those cases.
It was quite interesting as well. We were at Transport Logistics in Munich 2 weeks ago, and there was a very large part of the occupier market is there for the logistics side. And very much a big part of that discussion was logistics buildings becoming energy hubs as well. So a real change in terms of how they're perceived as an asset as well and location. We're coming up to the end of the time, so I just wanted to ask one kind of question for all of you, which is, I guess, if we come back again here next year at the same time, subject to an interview, an invitation, obviously, Tom. But if we do you think, how much further do you think will we be along? And it's been interesting to see how this discussion has evolved over the past year, actually, and the acceleration in terms of just people thinking that it's an interesting strategy and yes, we must do something about it, to it actually being about tangibly what people can do. So where do you think we will be next year? Will we have moved forward? Thomas, let's start with that.
That's a question, at least what I hope next year. Of course, general markets will be opened up again, global capital flows will be back to normal, let's say interest level will be on a balanced level, not the level we have seen 18 months ago, but on a balanced level, a market is back, and hopefully a differentiated market where new investments are more or less, not only, but focused flow into ESG compliant buildings or strategies. That would be my hope, and I think we'll see some of that.
Okay, good. Steve?
So from my point of view, I think that the thing that is changing, that I see changing most rapidly at the moment, is the way funds are now specifying their sustainability requirements down onto the developers and onto the designers of those buildings. I think they're becoming more educated, and I think that is going to become more the norm. So I think we're going to see better guidance from the funds of what they're looking for. And I also think the funds are busily doing a lot of work with their current asset portfolio and trying to quietly move away things that they don't really want to hold anymore. So I think those are the things that are starting to happen. So yeah, with the regulation coming down from the funds, coming in from national regulation, I think we'll have a better control and a better set of standards to work to.
Great. Anna?
I agree with both of you. I would add one more factor to it, and that's peer pressure. We've seen a lot of developers that we worked with in the last year that as soon as they started publicly announcing what they've been doing, other developers will say, well, why am I not doing the same thing? So in combination with the regulation and the investors' pressure, I think the peer pressure will do some magic. And next year, things will be a lot better.
Okay, good. Christian, you like that positivity?
I'd say we are seeing two different scenarios. One is, as Thomas described, markets are hopefully back to normal, where projects are happening again, and you really can advance with your ideas and your new developments. Because let's really be honest here. Right now, if you're looking outside, it's more or less a bloodbath. Projects are getting stopped. No investments happening. So if that changes again in the next 9 to 12 months, that would be terrific for the entire industry. Because everybody would be back to normal, working on the projects that really make an impact. If that doesn't happen, and chances are that the situation may be a bit longer than we expect, I think what Stephen said can be quite relevant, that the asset managers that have assets that need to be optimized are starting to work in detail on these assets, and therefore giving a new push to the market, because when you're working with existing assets, it's still something that's going on. So two scenarios: one, everything sunshine again, and the other one, even when it's not sun, will survive.
Yes.
Well, I would stop them with a more positive outlook by comparison, because the warehouse market is not a bloodbath at this point, but it's slowly slowed down. Surely slowed down. This is easy to see. as I said, we think we are in fact-finding mission right now. So we're trying to find out what is the right strategy forward, and it feels a bit like we're in the jungle. There's so many strategies, there's so many technologies, there's so many regulations. We're growing into those surely but slowly. In a year's time, construction is generally more like a tanker, so it's very slow. You decide on a path and it takes 1 or 2 years until you can see the fruits of your labor and get the data you actually need. So in 1 or 2 years' time, I hope that we have enough data from finished projects with different ways to tackle ESG, that we actually can see a clear path forward, which is the right technology, which is the right solution to get there. Of course, this will all be held in place a bit by the regulations, which will be more rigid probably at that point in time, but that will help us as well.
Okay, good. Thanks very much for joining us. Drinks are now going to be served next door. If you are watching this on demand, thank you very much for watching. Because we're all meeting in person, we're about to have a drink, we can all give ourselves some applause for all of that. Thanks very much.